Ladies and gentlemen, by this time tomorrow, the financial world may look exactly the same on the surface. The buildings on Wall Street will still be standing. The news anchors will still be smiling. The trading screens will still glow with red and green numbers. But beneath that familiar surface, something could change in an instant. Because tomorrow, one announcement has the potential to reshape expectations across the global economy. Not because it magically creates wealth or destroys it overnight, but because it influences something even more powerful: confidence. And when confidence shifts, markets move, stocks move, currencies move, bond yields move, and almost every time those pieces begin moving together, gold and silver respond. If you've worked for decades to build your savings, if you've chosen to own precious metals because you believe in protecting purchasing power, or if you're simply trying to understand why these markets seem so unpredictable, then the next few minutes may be some of the most valuable you spend today. Because tomorrow is not just another date on the calendar. It's one of those rare moments when millions of investors around the world stop looking backward and begin looking forward at exactly the same time. History has shown that these moments can create enormous opportunities, but they can also create expensive mistakes. The biggest mistake isn't being wrong about where gold goes next. The biggest mistake is reacting emotionally before understanding why the market is moving in the first place. That distinction has separated successful investors from panicked investors for generations. And tonight, that's exactly what we're going to explore. Not by making dramatic predictions, not by promising impossible price targets, but by understanding the forces that are actually driving the market. Because markets rarely move because of one headline. They move because expectations collide with reality. And tomorrow, that collision could be significant. For weeks, analysts have debated what the Federal Reserve will do next. Some believe policymakers have already done enough to slow inflation. Others argue inflation remains stubborn enough to justify keeping monetary policy restrictive for longer. On the surface, that sounds like a disagreement between economists. In reality, it's something much larger. It's a disagreement about the future cost of money. And that matters because nearly every asset on Earth is influenced by that single idea. When money becomes more expensive to borrow, businesses slow investment. Consumers reduce spending. Mortgage payments become heavier. Corporate profits face pressure. And investors begin asking a simple question. Where should my capital be? That question affects everything. Technology stocks, government bonds, commercial real estate, the US dollar, and yes, gold and silver. One of the biggest misconceptions among new investors is believing that gold rises simply because inflation exists. If only markets were that simple. Gold doesn't respond to headlines. It responds to expectations. Sometimes inflation rises and gold falls. Sometimes inflation falls and gold rises. How can both be true? Because markets aren't pricing today's reality. They're constantly pricing tomorrow's possibilities. Imagine two investors looking at exactly the same economic report. One believes inflation is finally under control. The other believes inflation will soon accelerate again. They've read the same numbers. Yet they'll make completely different investment decisions. Now multiply that process by millions of investors across every major financial institution in the world. That's what creates market volatility. Not certainty. Uncertainty. Tomorrow's announcement matters because it could reduce uncertainty, or it could create even more of it. And markets often react more violently to uncertainty than to bad news itself. Think about driving through dense fog. Most people don't become nervous because the road suddenly changed. They become nervous because they can no longer see what's ahead. Financial markets behave much the same way. Investors don't fear information. They fear the absence of clarity. Every Federal Reserve meeting attempts to reduce that uncertainty. Sometimes it succeeds. Sometimes it raises even more questions. That's why experienced investors rarely focus only on the decision itself. They pay attention to something even more important. The message behind the decision. Because two identical interest rate announcements can produce completely different market reactions depending on how policymakers describe the months ahead. The words, the tone, the confidence. Even a subtle change in language can influence expectations around the world. Tomorrow, every sentence will be examined. Every pause will be analyzed. Every answer during the press conference will be interpreted. Not because words change the economy overnight, but because words change expectations. And expectations move markets long before reality catches up. Now here's something that doesn't receive enough attention. The market isn't asking whether the Federal Reserve wants lower inflation. Everyone already knows that. The real question is far more difficult. How much economic pain is the Federal Reserve willing to tolerate in order to achieve it? That question affects businesses hiring workers, families buying homes, companies investing in expansion, governments financing debt, and investors deciding whether to own productive assets or defensive assets. Gold has occupied a unique position throughout financial history because it exists outside that entire system. It doesn't depend on quarterly earnings. It doesn't require a board of directors. It doesn't promise future cash flow. It simply exists. For thousands of years, civilizations across continents have assigned value to it during periods of uncertainty. That doesn't guarantee prices always rise. Far from it. Gold has experienced painful declines throughout history, but its role has remained remarkably consistent. When confidence in financial systems becomes uncertain, investors often revisit assets that cannot be created by policy decisions. That's why tomorrow matters. Not because one meeting changes everything forever, but because every important trend begins with a single moment when expectations start shifting. Sometimes those shifts last only days. Sometimes they define entire years. The challenge is recognizing which kind of moment you're witnessing. And that's exactly what we'll explore next. Because while millions of investors are preparing for tomorrow's announcement, some of the world's largest financial institutions are already watching something much bigger. Something that extends far beyond a single interest rate decision. And understanding that bigger picture may ultimately matter far more than tomorrow's headline itself, the signals most investors never watch. If you've ever watched gold fall on what sounded like good news, you're not alone. In fact, one of the most frustrating experiences for precious metals investors is realizing that the headline they expected to move the market barely mattered at all. Meanwhile, something they never even noticed quietly determined the direction of prices. That's because professional investors rarely begin their day by asking one question. Instead, they ask something much more revealing. What is the bond market telling us? Because long before gold makes a meaningful move, another market often whispers that something is changing. And those whispers can become incredibly valuable for investors willing to listen. Imagine trying to predict where a river will flow by staring only at the water in front of your feet. You might notice small waves. You might even notice the current speeding up. But you'll never understand why unless you look upstream. The same principle applies to financial markets. Gold is often downstream. The forces moving it begin somewhere else. And one of the most important places to watch is the US Treasury market. Government bonds may sound boring. They're certainly not the topic that dominates dinner conversations. Yet they influence nearly every corner of the financial system. When investors buy bonds aggressively, yields generally move lower. When they sell bonds, yields tend to rise. Those changing yields affect borrowing costs for businesses, mortgage rates for families, corporate financing, and eventually, investor appetite for assets like gold and silver. It's a chain reaction. And tomorrow's Federal Reserve announcement has the potential to send that chain reaction through markets within seconds. Now let's make this simple. Imagine someone offers you two choices. The first is an investment guaranteed to pay attractive interest every year. The second pays no interest at all. Which looks more attractive? For many investors, the answer depends on one thing: how generous that guaranteed return actually is. That's why higher interest rates can create pressure for precious metals. Not because gold suddenly loses its value, but because competing assets begin offering stronger income. Yet here's where things become more interesting. Professional investors don't stop there, because nominal interest rates tell only half the story. What truly matters is purchasing power. Imagine earning 5% interest while inflation runs at 6%. Technically, your investment grew, but your purchasing power still declined. You're earning more dollars, yet those dollars buy less. That's why investors constantly compare interest rates with inflation expectations. They're not asking, how much am I earning? They're asking, how much purchasing power am I keeping? That subtle difference changes everything. Now let's add another piece of the puzzle. The US dollar. Gold is traded globally. Whether you're investing from New York, London, Singapore, or Sydney, the international gold market constantly interacts with the strength of the dollar. When the dollar strengthens sharply, it often creates additional pressure for commodities priced in dollars. When the dollar weakens, that pressure can ease. Notice something important. I didn't say it always happens. Markets are rarely that simple. Geopolitical events, financial crises, unexpected economic shocks. All of these can temporarily change relationships that normally hold true. That's why experienced investors avoid absolute statements. Instead of saying, Gold always rises when they ask, what combination of forces is developing? Because markets are puzzles, not equations. Tomorrow's announcement isn't just about interest rates. It's about expectations for everything that comes afterward. Will borrowing costs remain elevated? Will policymakers hint that inflation remains their biggest concern? Will investors believe tighter financial conditions are likely to continue? Or will they hear subtle language suggesting that the most restrictive phase of policy may be nearing its end? Those questions matter because financial markets constantly look ahead. The price you see today already reflects thousands of expectations about tomorrow. That's why markets sometimes rally after disappointing news, and sometimes decline after seemingly positive news. The surprise isn't always in the data. It's in how the data compares with what investors already believed. That's an incredibly important distinction. Now let's talk about something even larger. Liquidity. It isn't a word that appears in many headlines, but it quietly influences almost everything. Think of liquidity as the fuel flowing through the financial system. When that fuel is plentiful, businesses invest more confidently. Investors become more willing to take risk. Credit becomes easier to obtain. Economic activity often accelerates. But when liquidity becomes scarce, financial conditions tighten. Borrowing becomes more expensive. Risk appetite declines. And markets become much more sensitive to uncertainty. Many professional investors spend enormous amounts of time studying liquidity because they understand something ordinary investors often overlook. Markets don't simply react to earnings, or inflation, or interest rates. They react to the availability of money itself, and changes in Federal Reserve policy can influence that availability in powerful ways. Now let's step back for a moment. Imagine you're standing in front of an orchestra. Most people hear the music. The conductor hears every instrument separately. Professional investors try to think like the conductor. They're not listening to one signal. They're listening to dozens. Bond yields, currency movements, credit markets, liquidity conditions, inflation expectations, economic growth, employment, consumer spending, manufacturing activity, global trade. None of these tells the whole story alone, but together, they begin forming a picture. And tomorrow may add another important piece. There's another mistake many investors make during major Federal Reserve meetings. They assume the first market reaction must be the correct one. History suggests otherwise. Financial markets often experience violent moves immediately after important announcements. Algorithms react within milliseconds. Institutional traders reposition portfolios. Short-term speculation explodes. Prices can swing dramatically. Yet hours later, or days later, markets sometimes reverse completely. Why? Because the first reaction often reflects speed. The second reflects analysis. That's an important difference. The fastest investor isn't always the most successful. Sometimes patience becomes a competitive advantage. Sometimes the best decision is allowing information to settle before reaching conclusions. That doesn't sound exciting. It won't generate dramatic television headlines. But investing has rarely rewarded emotional reactions over disciplined thinking. Tomorrow's announcement may produce exactly the kind of volatility that captures global attention. Prices could move quickly. Commentators will rush to explain every fluctuation. Social media will fill with confident predictions. Some will declare the beginning of a massive bull market. Others will insist precious metals are finished. The truth is usually more complicated, because one announcement rarely changes a long-term investment thesis overnight. Instead, it changes probabilities, and successful investors understand the difference between certainty and probability. They never assume they know the future. They prepare for multiple possibilities. That mindset has protected investors through inflation scares, financial crises, banking panics, market bubbles, and economic recessions. So before tomorrow's headlines arrive, remember this. The gold price is only one screen. Behind that screen, bond markets are speaking. The dollar is moving. Liquidity is shifting. Inflation expectations are evolving. And millions of investors are quietly adjusting portfolios based on those hidden signals. Gold doesn't exist in isolation. It reflects a conversation happening across the entire financial system. Tomorrow, that conversation may become louder than it has been in months. But even then, the smartest investors won't be asking only what happened today. They'll be asking a much more important question. What does today's decision tell us about the next 6 months? Because that's where fortunes are often made, or protected. 3 possible futures, and the decision that matters most. Now we've arrived at the question everyone is asking. What happens tomorrow? The honest answer is, no one knows with certainty. Not the television commentators. Not the analysts updating their forecasts every hour. Not even the largest investment firms on Wall Street. If anyone tells you they know exactly what gold or silver will do after tomorrow's announcement, be careful. Financial markets have a habit of embarrassing people who sound absolutely certain. The better approach isn't predicting one future. It's preparing for several, because every experienced investor understands something that beginners often overlook. Markets don't reward certainty, they reward preparation. So let's walk through the three paths that could unfold. Scenario 1, the Federal Reserve stays firm. Suppose policymakers leave interest rates unchanged, but make one thing very clear. Inflation remains their primary concern. Future rate increases remain possible. Financial conditions must stay restrictive. If that's the message investors hear, bond yields could remain elevated. The US dollar could strengthen, and precious metals may experience renewed pressure. Would that mean the long-term story for gold has ended? Not necessarily. It would simply mean that investors expect higher borrowing costs to remain in place longer than previously believed. Markets constantly adjust to expectations. Tomorrow could become another adjustment. It wouldn't rewrite history. It would simply extend the current chapter. Scenario 2, a more balanced message. Now imagine something different. Interest rates remain unchanged. But during the press conference, policymakers acknowledge progress. Inflation has improved. Economic activity is moderating. Future decisions will depend on incoming data rather than predetermined plans. Notice something important. That isn't the same as declaring victory. It's simply introducing flexibility. Bond yields could ease. The dollar might lose some momentum. Gold and silver could find support as investors begin looking beyond today's restrictive conditions. Not because everything suddenly became perfect, but because expectations quietly changed. Remember, markets trade tomorrow, not yesterday. Scenario 3, an unexpected surprise. History teaches us that markets are often shaken not by expected events, but by unexpected ones. Perhaps policymakers deliver language nobody anticipated. Perhaps new economic projections change the outlook. Perhaps future risks receive greater attention than investors expected. Nobody can rule out surprises. And that's exactly why volatility often surrounds major policy announcements. When expectations and reality collide, prices adjust rapidly, sometimes dramatically. The first reaction may be emotional. The lasting reaction usually comes after investors have time to absorb the details. That's why experienced investors rarely judge tomorrow's outcome within the first few minutes. They understand that markets often need time to discover what actually matters. Now let's step away from tomorrow altogether. Because while millions of investors are focused on the next trading session, some of the world's largest institutions are thinking years ahead. Ask yourself a simple question. Why do central banks continue holding substantial gold reserves? Why haven't they replaced every ounce with government bonds? Or technology stocks? Or digital assets? Because their mission isn't maximizing quarterly returns. Their mission is preserving confidence during periods of uncertainty. Gold occupies a unique role inside that strategy. Not because it's perfect. Not because it never declines. But because throughout history it has remained an asset without credit risk attached to another institution's promise. Governments can change policies. Currencies evolve. Markets fluctuate. Economic cycles come and go. Yet across generations, gold has continued to occupy a place inside national reserves. That doesn't guarantee future performance, but it explains why many institutions continue treating it differently than ordinary investments. History also reminds us of something else. The biggest investment opportunities rarely felt comfortable while they were happening. Think about periods of financial stress, moments when headlines predicted endless crisis. Times when uncertainty dominated every conversation. During those periods, many investors sold quality assets simply because fear became overwhelming. Later, when confidence returned, those same assets recovered, not because fear was irrational, but because fear rarely lasts forever. Market psychology moves in cycles. Optimism becomes excessive, then pessimism becomes excessive. Successful long-term investors spend less time chasing emotion, and more time understanding where they are within that cycle. Tomorrow's announcement may influence short-term prices. It cannot erase the existence of long-term cycles. There's another lesson worth remembering. Financial history is filled with moments that seemed incredibly important. Until a few years passed. Go back 20 years. Think about the emergency headlines that once dominated financial television. Many felt world-changing. Some genuinely were. Yet most gradually became chapters inside much larger stories. Markets continued evolving. Economies adapted. New challenges appeared. The reason this matters is simple. If your investment horizon measures decades instead of days, every headline deserves perspective. That doesn't mean ignoring risk. It means refusing to confuse short-term volatility with permanent change. So what should thoughtful investors actually watch after tomorrow? Not just the first headline. Watch how bond yields respond. Watch whether the US dollar strengthens or weakens. Watch how markets behave after the initial excitement fades. Watch whether economic data over the following weeks confirms or contradicts the message policymakers deliver. Because one announcement begins a conversation, it rarely finishes it. The market will continue collecting new evidence, and expectations will continue evolving. Perhaps the most valuable lesson of all has nothing to do with economics. It has everything to do with discipline. Every investment journey eventually presents moments of uncertainty, moments when emotions encourage immediate action. Sometimes action is appropriate. Sometimes patience is the wiser decision. Learning the difference is one of the greatest skills an investor can develop, not because patience always guarantees success, but because emotional decision-making has repeatedly proven expensive throughout financial history. When uncertainty increases, clarity becomes more valuable than speed. Understanding becomes more valuable than prediction. Preparation becomes more valuable than confidence. So as tomorrow approaches, remember why you invested in the first place. If your decision was based solely on next week's price movement, tomorrow may feel overwhelming. But if your decision was based on a long-term plan, tomorrow becomes only one checkpoint along a much longer journey. Markets will continue rising. Markets will continue falling. Economic cycles will continue changing. Interest rate policies will evolve. Inflation will eventually cool, and eventually return. That's the nature of financial history. The objective isn't avoiding every storm. It's building a strategy capable of surviving many storms. Before we finish, I'd like to ask you something. When markets become uncertain, do you become more patient or more anxious? Have previous Federal Reserve announcements changed the way you invest today? Share your experience in the comments. Someone reading your story may be facing their very first period of market uncertainty. Your perspective could help them stay focused when emotions begin taking over. And if you found this breakdown helpful, consider subscribing, because once tomorrow's announcement is released, we'll return to examine what actually happened, how markets interpreted it, and what it could mean for gold, silver, and the broader economy in the weeks ahead. Until then, keep one final thought in mind. Tomorrow's announcement may influence prices. It may change expectations. It may create volatility. But no single press conference can eliminate the need for disciplined thinking. The investors who consistently protect and grow wealth aren't the ones who predict every headline correctly. They're the ones who remain thoughtful when everyone else becomes emotional. As the market opens tomorrow, don't chase the noise. Understand it. Because understanding, not urgency, is often the greatest advantage an investor can possess.